Over the past decade, the S&P 500 has returned about 7% annually, but the average retail investor has earned only about 2%. That 5% gap isn't taken by the market, it's given away by our own behavior. Before you can understand why you underperform, you must understand what you're actually tracking. The Dow Jones Industrial Average selects just 30 stocks and weights them by price. That means a high-priced stock like Goldman Sachs, at around $1,040, has far more influence than a $50 stock. This is crude and rarely used by professionals as a benchmark. The S&P 500, in contrast, covers 11 sectors and weights by market capitalization. Apple, with a market cap near $3 trillion, naturally commands a larger weight, reflecting where capital actually flows. The Nasdaq composite is heavily tech-tilted, so buying a Nasdaq ETF means you're essentially betting on a few mega-cap tech names. Finally, the Russell 2000 tracks small caps, which are highly sensitive to interest rates because they borrow more. Your choice of index defines your risk exposure. Let's make this concrete. In a price-weighted index, a stock's influence depends on its share price, not its total value. Imagine Goldman Sachs at $1,040 and Coca-Cola at $60. If Goldman rises 1%, it moves the index more than Coca-Cola rising 10%. That's distorted. Market cap weighting solves this by using total market value. Apple's $2.8 trillion market cap gives it about 7% weight in the S&P 500, which better reflects where investor money is actually deployed. So when a fund claims it beat the Dow, be skeptical. The benchmark itself is flawed. Beating the S&P 500 is more meaningful, which is why most passive funds track it. Understanding this distinction is your first step toward choosing the right index. ETFs are a great invention, but they're not perfect replicas of their indices. First, management fees. Many S&P 500 ETFs charge as little as 0.03%, but some thematic funds charge up to 0.75%, which compounds into a significant drag. Second, tracking error, the deviation between the ETF's return and the index's return. This arises from dividend reinvestment timing, cash drag, or synthetic replication risks. Third, the bid-ask spread and trading commissions. If you trade frequently, these friction costs can eat half your returns in a year. The key is to look beyond the expense ratio and examine the total cost of ownership, including tracking error and spreads. Tracking error measures the volatility of the difference between an ETF's daily return and the index's daily return. The formula is the annualized standard deviation of these daily differences. If an ETF has a tracking error of 0.2%, it means that in about 2/3 of years, its return will differ from the index by less than 0.2%. Over a decade, this compounds. A low tracking error is crucial, especially for long-term investors. You can find this number in the fund's prospectus or on its website. When comparing ETFs, don't just look at the expense ratio. A 0.2% tracking error with 0.05% fee might be better than a 0.03% fee with 0.5% tracking error. As of August 7, 2026, the S&P 500 closed at 7,757.64, up 2.07% over the week. The tech-heavy Nasdaq 100 finished at 26,690.62, gaining 3% for the week, while the Dow Jones Industrial Average advanced 1.61% to 54,036.93. Over the past 3 months, the Dow has climbed 8.74%. This rebound has pushed the S&P 500's RSI, 14, near 70, but the Nasdaq's 20-day annualized volatility remains elevated at 23.1%, signaling that tech swings are far from over. Rapid rebounds often tempt investors to chase gains, which is a common source of underperformance. If your portfolio lags during such a recovery, it may be due to sector weight differences or missing the rally because of frequent trading. These numbers aren't for prediction, they're for maintaining sensitivity to market temperature. Growth stocks behave like long-duration bonds. Most of their value comes from earnings far in the future. When interest rates rise, those future earnings are discounted more heavily, so growth stocks get hit hardest. Value stocks, with cash flows closer to today and high dividends, are more resilient. In 2022, when the Fed hiked rates quickly, tech-heavy growth stocks fell over 30%, while energy and financial value stocks actually rose. This is the invisible hand of interest rates. Many investors ignore this macro variable and focus only on company stories. To avoid being caught on the wrong side, watch the Fed's policy path and market-implied rate expectations, and adjust your growth/value exposure accordingly. The price-to-earnings ratio is the most direct way to distinguish growth from value. A growth stock might trade at 50 times earnings, meaning it would take 50 years of current profits to pay back your investment. A value stock might trade at 8 times earnings. But a high PE isn't automatically expensive. If earnings are growing at 30% annually, the multiple can be quickly justified. However, there's a trap: earnings forecasts are often wrong. When the economy slows or rates rise, growth stocks can suffer both from lower earnings growth and from a contraction in the multiple, a double whammy. So always ask, can the moat support high growth? Is the current rate environment favorable? The Fama-French three-factor model showed that small-cap stocks historically delivered extra returns because they carry more risk. But over the past decade, that small-cap premium has largely disappeared in the U.S. One reason is the rise of index investing, which has funneled money into large caps and marginalized small caps. That doesn't mean small caps are dead. In phases of falling rates and economic acceleration, small caps often surge because they rely more on borrowing and domestic demand. Currently, large-cap tech dominates the market, but that concentration itself is a risk. Adding some small-cap value can diversify your factor exposure and reduce the impact of a style reversal. Just remember, small caps are less liquid and may be hard to sell in extreme conditions, so keep the allocation controlled. Looking only at returns without risk is like driving with your eyes closed. The Sharpe ratio solves this by measuring how much excess return you get per unit of volatility. The formula is the excess return, portfolio return minus risk-free rate, divided by the portfolio's volatility. For example, a portfolio with a 10% annual return, a 4% risk-free rate, and 12% volatility has a Sharpe ratio of 0.5. A ratio above 1 is considered good. Historically, the S&P 500's Sharpe ratio has ranged from 0.4 to 0.6. Many retail investors chase high returns but ignore the volatility that makes them hard to hold, often leading to buying high and selling low. If you measure your own portfolio, you may find your Sharpe ratio is far below the index. The goal should be to improve risk-adjusted returns, not absolute returns. The largest cost is you. Studies of brokerage accounts show that retail investors have high turnover, and high turnover is negatively correlated with returns. Why? Because frequent trading generates friction costs, and it's often driven by emotion. Every news headline, every price tick can trigger impulsive decisions. Chasing gains and panic selling are expensive. For example, selling during a sharp drop and then missing the rebound, which is exactly what many investors face in the recent market bounce. The key to successful index investing is to look at your account less and make fewer decisions. Set a simple rebalancing rule, like checking quarterly and rebalancing if your target allocation drifts by more than 5%. This kind of discipline can help you outperform most active traders over the long run. Understanding index construction is step 1. The Dow is price-weighted, the S&P 500 is market cap-weighted, and the Nasdaq is a tech-heavy market cap index. Choose the right benchmark for your goals: the S&P 500 for broad U.S. exposure, the Nasdaq 100 for tech, and the Russell 2000 for small caps. Use ETFs to implement, but always check tracking error and total cost. A 0.03% fee with 0.2% tracking error is riskier than a 0.05% fee with 0.05% tracking error. Also, consider valuation and the rate environment. With current valuations not cheap and growth stocks volatile, blending some value or small cap value can smooth the ride. Finally, discipline is the only free lunch. Set a rebalancing schedule, stay invested, and let the index's own power compound your wealth. Should I switch to a lower fee ETF? Only after comparing tracking error, not just fees. How do I know if I'm too concentrated in tech? Check your sector weights against your benchmark. What if the market drops after I rebalance? Rebalancing is about discipline, not timing. Can I just buy the S&P 500 and ignore everything? It's a solid start, but you must stay invested through volatility. We've broken down the underlying logic of U.S. indices, from the weighting algorithms of the Dow, S&P, and Nasdaq, to the hidden costs of ETF tracking error and the rotation between growth and value driven by interest rates. We've also touched on the behavioral traps that erode returns. The central takeaway is that the index is a set of rules, not a prophecy. Passive investing succeeds when you understand those rules, control costs, and maintain discipline. The 5% gap between the market's return and the average investor's return is largely self-inflicted. By choosing the right benchmark, minimizing tracking error, and sticking to a rebalancing plan, you can close that gap. Remember, risk management first, returns second. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.